Money Radio for a really great future. We're talking real money.
Why do you invest? That is the question. What are you investing for? For many of us, the goal is to make as much money as humanly possible as fast as possible. And if that's the case, well, we've got some strange advice for you. If that's not the case, then maybe you need to understand why you're investing and what the problems are with some of the ways we try to do this. Hi, everybody. I'm Don McDonald. Welcome to Talking Real Money, the radio show that becomes a podcast. And along with me in the mountainous region of Washington out there in the middle of nowhere somewhere is Tom Cock.
Mountainous, windy, rainy, cold, miserable, but great day to talk about money. Really is.
855-935-TALK is our phone number. That's 855-935-8255. We welcome, in fact, we encourage your calls every Saturday from noon to 2 when we do the live show here on Northwest News Radio in the Seattle area. So give us a call, 855-935-TALK, 855-935-8255. So, you ever heard of Tina investing? I hadn't. It means there are no alternatives. This comes from an article by our buddy Jason Zweig at the Wall Street Journal, who basically says, should you just stop trying to buy all this other stuff and just buy stocks?
Yeah, I mean, the newly updated analysis by a team of researchers who find that, and listen carefully here, retirement savers shouldn't own any bonds at all. Let me say that again. The research shows that you should just invest in stocks and accept the volatility that comes along with that because you've made more money. You started the show something about making as much money as you possibly can, and this is your recipe for doing that, I guess.
So basically what they're saying is something we already knew, that stocks have in the past, and probably will in the future, make more money than bonds. So, I mean, really? That's not a surprise, is it?
Shouldn't be. They're riskier assets. This is investments in companies versus bonds, which are, you know, an IOU, a piece of paper issued by a government or a corporation telling you that they'll pay you back with a certain amount of interest in a certain period of time. This research now, by the way, goes back from 1890 through 2023. Their central finding, and this is from Jason, across the decades and around the globe, bonds have historically tended to go up and down in sync with stocks over long periods, making them poor diversifiers while offering low returns to boot. Now, long periods to me is the operative two words there, because I've seen bonds work very, very well at absolutely 100% critical times when people were really freaking out. Think 2008, 2009. Think spring of 2020.
Maybe
there are times.
That terminology may even be just a little misleading. They didn't perform well. They just saved you from.
Well, they've made money in both of those periods.
But they didn't make much.
Well, the spring of 2020, the right type of bonds made about 10%, while stocks went down over 30%. So. For a period, that really helped you. Yeah. And if you were somebody rebalancing, you were selling bonds and buying stocks just in time for stocks to go back up. 2008, 2009, again, you're right. They didn't make a ton of money, but they made money while stocks got absolutely creamed. Keeping people in their seats is the way I would look at it, Don. And so, and here's the other part I don't understand. The 1/3 in U.S. stocks and 2/3 in international stocks. I didn't really see a rationale behind overweighting.
Well, that was from the article somewhere, and it just sort of was thrown out there without any explanation. So I didn't even know if we should mention that one because
it's
they
confusing.
Really didn't say.
Yeah.
Why?
And even in their own study found that what U.S. stocks made 7.74, international 7.03. So it sounds to me like U.S. did better over a long period of time. Again, so there's some things here. Yes, you're right. Had you just invested in the right stocks for the last 20 years and were willing to take the ups and downs, you made a lot more money. No question. But you had to deal with, as I said a moment ago, some real tough teeth-grinding downturns that most people just quit. They can't take it.
Yeah, I mean, the article states that stocks underperformed bonds in a quarter of all rolling 30-year periods they tested. So that means, and it's those numbers are a jive with the stock returns, because basically stocks have risen in 3 out of every 4 years on average. 75% of the time stocks have gone up, 25% they've gone down. So, yeah, they've gone down at times, and during those times, bonds outperformed. But I think we're missing the bigger picture here, aren't we?
Yeah, you are, because, again, you just if it's just about making a massive amount of money, there's lots of ways to do that. It's not a Tina formula. It's a gut check formula. Are you willing to accept those massive downturns that really send most people to the sidelines because they just can't take it? It's a day after day thing. I'm old enough to certainly remember the dot-com bubble, the financial crisis of 08-09, the COVID downturn of 2020. Those are times that test investors' souls, and most people can't get from here to there without doing something which we know is a bad thing, and that is selling out at the wrong time.
I don't believe that that pretty much anybody, with very few exceptions, is yelling, buy bonds because they're likely to make you more money. That's certainly not us. We don't say that. We say buy bonds to balance out the downturns, to make it more comfortable. 855-935-TALK is our number.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Let's get things straight. Our goal is not to find a way to make you the most money humanly possible. We could do that, but you're going to suffer at times. And before we leave this article and go to the phones, in the article, Jason Zweig isn't saying you should own stocks either.
No, he says he owns bonds.
Grabbing headline.
Yeah, he says he owns them. Yep.
And one of the real reasons why we have it is because when you don't know when you're going to retire. You don't know what kind of a market you're going to retire into. And he got together with Alan Roth out of Colorado Springs, who's a fee-only advisor, and they ran some numbers. If you retired right after the bear market of 1999.
No, bull market of 99.
The bull market,
into the bear market of
2000.
Yep.
Versus the other after the bear market of 2002.
Yep. That's quite a difference.
It's a 3-year difference.
Yep.
But if you had retired before the downturn, you would have had a lot less money at the end of your retirement than you would have had a lot less money, like $3 million
understating
less.
It. Yeah.
One you end up with less.
900,000, the other end up with 4 million.
Yeah.
That's quite a difference.
You don't know what we can't predict what the market's going to be like at the time. That's why we bore you with this idea of diversification.
Yeah, I mean, diversification in stocks. Diversification is, and if you own bonds, that is a diversifier. They are very different security. We can get into the performance of them, but they're a very different type of security.
See, they're saying that they're not non-correlating.
Yeah, okay.
But they're a different kind of security. They just tend not to lose as much in a bad market.
Thank you. Or, again, I pointed out a couple examples where they actually made a little bit of money while everything else was getting creamed. So I would still own them. I still own them. You own them. Yeah. I mean, Jason still owns them. So get over yourself. Is it going to mean less return in the future? Probably. You'd probably be able to keep your emotions in check, too, which is bigger part of the game, my friend.
855-935-8255. Call that number because we love to try and help you with your specific situation, too, as opposed to the general stuff we talk about at the top of the hours. Let's go to Georgia. And Jay, you're up. Welcome to Talking Real Money.
Hey, good afternoon, Don. Tom, how are you?
Good. Thanks for calling.
I wanted to run my withdrawal strategy by you. I'm almost 54, and if things go well, I could be retired in, or at least step away from full-time work in like 5 years. And so I've been trying to noodle out what a withdrawal strategy looks like. And my current plan is to do this. I have a handle on my wife and I, our basic living expenses, not living our best life kind of thing, but just our normal expenses. And it's roughly 2% of our portfolio based on projections. And so my strategy is, since I'm 5 years away, is to sell, that percentage of our investment and to purchase a 5-year CD. And then I would do the same thing like a year from now and 2 years from now. I would continue.
So you're building a ladder,
a CD ladder starting the year that to pay you when you would be leaving, as you say, full-time work.
Okay.
Correct.
Yeah.
So first question, am I on the right track in doing that?
It's disciplined.
Yeah, it's disciplined. I like that.
Okay.
There's not one exact strategy that fits everybody, and this is a way to essentially fund your pre-retirement or your early retirement or whatever it might be in a way that's relatively easy to count on. So I'm okay with it. I think it's you're thinking it out and you're creating a plan, and that's generally the key. It doesn't really matter what the details are, how you take it out. For me, I probably just take it out every year at the end of the year or the beginning of the year and put that in a high yield savings account and live off that. But I see what you're trying to do. You're trying to get ahead of the curve and have this rolling 5-year CD coming due off of which you can live. Makes sense to me.
Correct.
It becomes part of your bond portfolio, too.
Oh, good point. Thank you. I know there's other types of ladders, like you could do treasuries or bonds. It seems like CDs offer the most simplicity. So are there advantages that I'm missing?
No. To some of the others? The only other one that might make sense is for someone in a very high bracket where you ladder munis. But CD ladders are nice because they tend to be just a smidge more lucrative because of the competition between banks than treasuries are, because the Treasury doesn't have anybody competing with the Treasury. It's the Treasury. So your yields, and while CDs are not, it's matters of degrees. CDs are not as safe as treasuries because they're not direct obligations of the government, but they're pretty doggone safe because they are backed by a government fund that is full faith and credit. So I think it's fine. And it's easy. You're right. It's so easy to build these brokered ladders of CDs.
I guess last question then, seems like I'm on the right track. Obviously, investing in a CD ladder is kind of insurance against having to withdraw in a downturn. So what if I'm on this course and let's say the market corrects and it's down by 20%? I just don't fund the ladder that year?
No, you still fund it. You still fund it. That's why I say it doesn't really matter. It's the same as taking it out every year, essentially, taking the 5-year flexible. But you still should fund it, because then to do otherwise, you're trying to time the market. You're going, well, when do I fund it? And then you've taken away the discipline.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Hello again. Welcome back to our little get-together called a talk show and a podcast. I'm Don McDonald, along with Tom Cock, talking real money with you at 855-935-TALK, 855-935-8255. And let's go to Sammamish, Washington. And Jason, Welcome to the
Good
show,
afternoon,
Jason.
gentlemen.
What the heck do you want to talk about?
Okay, now wait a
today,
minute.
Jason?
Actually, this is perfect because we need to ask you something important. Would you give the boss, a.k.a. I forget his name. Anyway, would you give him the $1 trillion, or what's the deal?
Oh, you mean Musk?
Yeah,
Musk.
would you give him?
Of course, it's gonna mean bankruptcy for the company if he leaves. I mean,
I know, but okay, full stop there. Doesn't he hold like 1/3 to 40% of the stock or some ridiculous number?
Yeah, would he be cutting off his own nose?
Elon is the company. Elon
Right.
is
So
the company.
so if he doesn't get the money and he quits, he costs himself however much money, right? Because then the stock goes to whatever, way down. I don't understand this.
It's a negotiating.
I
tactic.
see.
The board knows that they'll never walk. All right.
Okay. All right.
On my question.
Jason has another question.
Okay, well, we have a shareholder meeting on Monday. We're going to try the same thing. We're just going to say it's $1 trillion, boys, or whatever. You guys decide. I don't know. So,
Good luck.
okay, see what
Yeah,
happens.
well, they won't be the same without us.
Exactly.
All right, go ahead, Jason. Tom's not going to interrupt again,
All
I
right,
promise.
Please.
So I know you guys are a big fan of Michael Saylor.
Yeah,
Oh,
man.
yeah, huge, yeah. Okay, explain who Mr. Saylor is, Don.
Strategy, MicroStrategy,
Yeah.
now strategy.
Yeah, they changed the
AKA
name. Rebranded,
Bitcoin.
yes.
Yeah.
Yeah. So they have these instruments called, I'm sure you're aware of, Strike, Strive, Stretch, and Strife. Now, these are...
Is that my workout routine?
That are, so they're high-yield dividend instruments that are basically... the reason they came to my radar is I heard that they're more tax efficient than bonds. Now, I'm sure you guys would challenge this, and I want because their return of capital versus yield. So I kind of wanted to get your opinion on that, and because if they're a safer, well, they're probably not safer, but if they're a strategy similar to that of bonds and can offer a tax advantage, what are your thoughts on that? I mean, I know you again in general don't like anything for touching Bitcoin, but.
So you're eating away your own principal as you're
right,
reducing your tax bill.
Yeah, I mean,
Good,
okay,
yeah.
let's start with this. Where the heck is he going to get the money to pay the 8% annual dividend?
Wow.
What if, let's just hypothetical, because it's done it before. Let's say crypto crashes 50%.
Yeah.
Where's he getting the money to pay that dividend? He's got no earnings.
I totally agree that the strategy is based on, crypto not cratering, obviously. But
Yeah.
I don't think minor moves in Bitcoin, 15 to 20% are going to. Now, if it craters 75 to 80%, then yeah. But I think, I don't know. If it craters a smaller percent, I think they can weather that storm. I don't know. It just seemed like...
This seems very gimmicky. One, the names. The names are just incredibly gimmicky. I mean, this was built to memeify. This was created for Reddit. This got Reddit written all over it.
We got to ask, where do you read this? We got to ask too, Jason. Just sorry to interrupt you, but where do you read this stuff? Where do you find this?
I actually heard about it on a Bloomberg interview. Michael Saylor was dealing with somebody from Bloomberg. Yeah.
Okay. They got to fill 24 hours too, I guess. So
this is complicated.
Well, just all I say is look into them and see what you think. Like, I'm curious. Once you delve into a little more, yeah.
I've got them. I've got all the details right here in front of me. 8% dividend on Strike, a 10% dividend on Stride, and they're based on the dividend paying power of MicroStrategy.
Yep.
That is what backs them up. That's all that backs them up is strategy. Therefore, I think strategy, personally, is a ridiculously high-risk stock. So, therefore, their preferreds are going to be ridiculously high-risk prefereds.
You might take...
Let me ask you this.
Go ahead.
Yeah, go ahead, Tom.
No, you please.
I was going to ask. So there are other companies that are... there are a number of companies that are partaking in the same strategy that strategy is partaking in with regards to Bitcoin. So,
and I wouldn't buy a single one of them.
If they're so wrong, then why are all these other companies adopting it?
Oh, I love this.
Oh,
I love
that's
this
good.
one.
Yeah.
This is almost that straw man argument. Okay, let me try this on you. I'm going to try this. I'm going to play your mother. If everybody was jumping off a bridge, would you jump off the bridge?
And Jason, instead of reading Reddit next week, maybe take up Andrew Ross Sorkin's book on 1929. That would be my suggestion.
I got to tell you, anybody who's offering, we don't even suggest preferred, period, at all, for anybody, even a preferred fund. That's how much we don't like preferreds. 855-935-TALK.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
855-935-TALK is our phone number. It's a good thing I'm a really fast reader because I do my best reading. Thank goodness for commercial breaks and news breaks because I was able to do some more reading on these
Snap,
silly,
Crackle, and
silly
Pop,
things.
and
Snap,
was,
Crackle,
yeah.
Pop, Strife,
Yeah.
Stupidity. I don't remember what they're...
Silly.
Anyway, silly. Here's one. Somebody once called them something like a leveraged Bitcoin ETF wearing an expensive suit. But here's my bottom line on them. Now that I've had a chance to do a little more reading, Strategy, MSTR stock, they do not have anywhere near the cash flow to support the dividends that will be paid out on this preferred.
Promised.
So how are they going to get the money? Only through capital raises, through selling new shares of stock.
Wait, isn't that called there's a name for that. There was an Italian guy who came up with that like 100 years ago. Ponzi,
yeah,
that was it.
Well,
yeah.
I was going to be nicer and just go Egyptian and call it a pyramid.
Okay. You're a nicer person.
It has a Ponzi-ish feel to it.
Well, you're going to take money from the new investors and give it to the old ones. That's kind of the plan there, generally.
Yeah. I mean, I honestly, I can't think of many things that are more scary that you could put your money in. Okay, yes. A casino, that's more scary. All right. But more fun.
But in the casino, you can sell cigarettes and booze. There's some money there. But
855-935-TALK is our phone number, 855-935-8255. We also get questions, not just from you calling on Saturday, but from you going to talkingrealmoney.com and asking them like this one that somebody sent to Tom.
Yeah, this came in from Bellevue. Oh, not
Washington?
that Bellevue. This is Bellevue, Nebraska. Huh?
I didn't even know there was one.
I did. Gregory writes.
Well, now.
I knew it before. In the portfolio view, because not very many Bellevues. A Bellevue Hospital. I think once somebody said, "You're from that Bellevue?" No, I'm not from that Bellevue. In the portfolio view.
Well, I would question that.
It's true. In the portfolio view of my IRA at Fidelity, I see this. Quote, did you know this account could earn you additional income by lending securities you already own?
Yes. Didn't we just have this
No.
recently?
No.
Oh, maybe I did on the Friday show. Okay.
Maybe you did. What is this? Would this add any gains to my account? What are the pros and cons of pursuing it? My wife and I listen to every podcast and love them. Thanks for all you do. And we'll take that, considering the other stuff that I got this week from comments from people. Yeah, so lending securities inside of your IRA to earn additional income. Now, I do know some people Dimensional Funds, for example, does a lot of this. They make a lot of money. They have a lot of securities, right? They lend out a lot.
They lend them out.
Yep.
They lend them out. But here's the problem. You're not likely to make much.
I was wondering what it would be.
It's tiny. Because remember, the split is at least 50-50. So half of the margin loan rate goes to the brokerage firm, and half, at best, goes to you. In some cases, you get as little as 15%.
Now, you should go back and explain what this is. This is lending securities that people want to short.
Right. Someone else wants to sell a stock they don't own.
Yep.
Well, they can't do that. You're not allowed to do that. You have to borrow the shares. Then you can sell them. You just can't make it up. Used to be a long time ago, prior to the crash of 29, you could even just make stuff like this up. You can't do that anymore. So you got to borrow it, and the brokerage firm that lends them to you, or the individuals, charge you a percentage of the value of those shares until you repay the shares. It's like a money loan.
Indeed.
It's just a stock loan. And right now, the numbers that I've seen for an average IRA investor with an average account under $1 million, you're just normal people accounts.
Mm-hmm.
Typically, the Just think of it. The amount you're going to make will vary somewhere between 1/10 of 1%. I'm sorry, 1/100th of 1% and 2/10 of 1%.
So so to your question, you might consider what is the snap, crackle, pop thing?
Yeah,
no,
stupidity.
Yeah,
if you have high demand individual stocks, things that are not heavily traded, lightly traded, individual stocks, you might make up to a whopping 1% per year, but that's only if you have a hodgepodge portfolio. If you, for example, if you own VT or AVGE, things like that, there's not going to be a lot of demand for borrowing those. Really,
the people that make money with this are the aforementioned dimensional funds. They manage $700 billion. Yeah. And so they lend those out, and all that adds up. With your account, probably not. So it's not something I wouldn't pursue it at all if it was me. But
yeah, I just was looking, and for example, VTI generally earns lending VTI with a smaller brokerage firm generally earns about 5 basis points a year. It's hardly worth the trouble.
You can do the math. Right, you can do the math. Find out yourself. Sure.
Yeah. So, would I bother?
No.
And there is a little bit of, there's really not, but there's a little bit of counterparty risk because the broker does get some collateral, but if everybody failed at the same time, you wouldn't necessarily get SIPC coverage because you lent the shares out.
Exactly. They'd be gone. Yeah.
So, anyway, no, I wouldn't bother. Not at all. 855-935-TALK is our phone number, 855-935-8255. And speaking of Vanguard and VTI and VT and all of that stuff, what's this about Vanguard becoming the hotbed for active funds?
Yeah, you don't think of them that way, right? You think of Vanguard, the great indexer. I mean, these are the people that really built indexing from nothing 50 years ago to where it is today. And yet, they have, as you may well know, considerable number of actively managed funds, and they're pushing harder in that area. We can spend some time talking about it.
Yeah, I would like to, again, because this has been something I haven't understood about Vanguard for a very long time, even when Jack Bogle was there, and all he would talk about was index, and yet they have all of these active funds, and now they're going into them more heavily.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Our phone number is 855-935-8255. That spells talk there at the end. And we're talking about Vanguard. Vanguard being the biggest mutual fund and ETF company anywhere. I mean, they're gigantic.
$1.9 trillion.
$2 trillion. That's not nearly as big as NVIDIA.
$5 trillion.
But here's the problem, and I think Vanguard recognizes that. In indexing, there has been, at least in terms of fees and profitability, there's been a race to the bottom.
And this is something that people forget.
How low can you go?
Yeah, if you give it away, it turns out that's not a great way to run a business. It's like, wait, there's no income? Yeah.
Essentially, I mean, when it comes to indexing, that's what Vanguard and Fidelity have been doing. I mean, Fidelity has a fund with 0 expenses. Right. Vanguard's VT is what, 3
basis points? 0.03. Yeah, I mean, it's pretty inexpensive. So, again, you're right. This is something people forget.
When it comes to active funds, they do have a huge advantage over their competition.
Because of the Vanguard name?
No, in that they charge generally less.
Oh, their fees are generally lower. And by the way, according to them, they're pounding their chest about the active, which John Bogle would not be happy about, but they're saying that 54% of their active mutual funds had outperformed the S&P 500 year to date. That's way better than the industry.
Which is better than the industry, because we know based on the SPIVA studies that S&P does, Standard & Poor's, that when you get out to 5 and 10 years, that about 80% fail to beat the indexes, depending on the stock category.
Somewhere in that area, and Vanguard's also pushing into cryptocurrency, private equity. I mean, this is the stuff that again, at their foundation, yeah, I know the foundation really was Wellesley Wellington, so that was active, right? No, there's no denying that. But the firm was built on these principles of low-cost indexing, set it, forget it, whatever term you want to use. Now they're making this real push, and they're blaming, for example, the new CEO. They're saying, well, he wasn't a Vanguard guy at the beginning. He came in, he's looking at the business going, as you said, Don, wait, we do more of that stuff over there. We make a lot more money than this stuff over here.
Here's, though, what sets Vanguard apart from T. Rowe Price and American Funds, the Capital Group, from Fidelity and the others, is that Vanguard, and this is something that's always stumped me a little, although I understand human nature. Vanguard is not a for-profit company.
Right. Each
Vanguard
fund
is a mutual
That's right.
operation that is owned by its shareholders, and therefore they shouldn't have a profitability incentive like a for-profit company like Fidelity would have.
Correct.
And that kind of bothers me because then it almost tells me they're doing this because they want to get a bigger compensation package for themselves. Pardon my cynicism, but that's what it tells me.
You know, Eric Barcelunas, who writes for Bloomberg, who we interviewed once on the show, says Vanguard is slowly starting to march to the beat of the market's drummer a little bit more. Again, as you said, they're sort of falling in with the other people that are out there peddling funds.
But I got to tell you, it's okay. Their percentage of funds that beat their indexes is better than probably any other fund group out there. It's right up there in the top. I don't know who's better necessarily. But a 54%, 54-46.
That sounds like a coin flip to me.
Underperform.
Heads or tails,
now,
which would you like?
If it was 90, I would go, we are on to something here.
Mm-hmm. Yeah, no, it's not 90. And remember,
they're at 54 because
10 months of the year.
Less.
That's for 10 months of the year. It gets worse as you go further. That's not 5 years. That's less than a year of performance.
Oh, well.
I mean, so you check it again in 3 years and see what percentage they're beating their indexes. It'll get smaller.
Although they do have a few funds that have, like, for example, Windsor 2, have consistently beaten their benchmarks year after year. I got to give them credit.
But if I woke up tomorrow and I had to decide between Wellington and the Vanguard Balanced Index Fund, I would take the Vanguard Balanced Index Fund. More
right,
diversification, lower cost, et cetera.
Even though Wellington or Windsor or whatever, they've slightly outperformed.
Yep.
The problem is with the tenths. It's, again, all about the tenths. They have outperformed. We have looked at numerous studies that have found that those that outperform over the previous 5, 10, or even 20 years tend to drop off and underperform in the subsequent 5, 10, or 20-year period. Some continue to outperform, but the majority fall from grace. So just because they've done well, that's not indicative. That's why every one of us in the business is required to say past performance is not indicative of future results.
Again, so if I was picking something, I would pick the lower cost. I'd pick the wider diversification and go with that rather than picking an actively managed fund. So, yeah, I'm not a fan of what Vanguard's doing, especially with the cryptocurrencies and the private assets. That is simply catering to what people are asking for, not, in my mind, and I know people are going to get mad at me, what they need.
Well, sir, that the whole industry panders.
Well, that's a major pander there.
And we know that. I mean, everybody we know in this industry does things that they go, Dimensional does it, where they go, oh, well, people are asking for more of this. We've
talked to them about their U.S. bias in their global funds. Yeah. They even said, well, because more investors in the U.S. Yeah,
it's really interesting, though. If you look at the S&P 500 funded Vanguard, its expense ratio, the VOO, the ETF, its expense ratio is 0.03%.
0.03.
And while Windsor has much lower fees, it is still more than
Windsor's
10
high.
times.
You said lower fees. It has higher fees.
Even though it had lower fees than some of its competitors.
Oh, okay, gotcha.
It's still more than 10 times the price on an annual basis of VOO. So you're working against a headwind.
$40 a gallon for gas or $4? You decide.
Ooh, that's a good analogy. 855-935-TALK.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
For your real life and real future, Tom and Don are talking real money.
All right, let's make Tom take the long trip across the cities, across the bridge, and into the city itself, Seattle, Washington. Craig, welcome to Talking Real Money.
Hey, guys. Hope you're doing well and enjoying the rain here. I had a question for you. So, pretty boring, but the three main holdings I've got are DFAW, ABGE, and ABGV. So they're all international. But in general, it only gave me about 28%. So I supplemented it with, since the end of 23, with AVNV, Alpha Vegas, Nancy Vegas. And I just never heard you guys talk about it. I wanted to get your take on it.
Well,
it's about 10% into that, and obviously I've been real happy with it, but haven't heard much about it.
Well, it's the new kid on the block. It's only been around about a year.
Yeah, 1 year, I think.
Which is the All International Markets Value ETF. I am a big fan of what you're doing because I think Avantis and Dimensional have been very chintzy on their allocation to international markets. I think they should follow more closely with what they were several years ago when we had almost a 50-50 split.
How about a decade ago?
A decade ago. I'm old.
Several years. Okay.
Yeah. But I just think I think the international exposure is too light personally in those funds. But that's
in the total market funds where it's about
which
roughly
is what
70% U.S., 30% international. What you're saying is you're going to add in AVNV. And by the way, envy is a bad thing when it comes to investing, but we'll leave it at that.
Envy.
So you're adding that in to increase your international exposure. Okay, that's fine. I mean, you're buying cheaper stocks than what you get in the U.S. And as Don said, traditionally, not that long ago, people said have half your money. So
it's only a 10% boost over the 28 or 29% average that he's going to get over DFAW and AVGE. So I am, by the way, me, personally, just me, a big fan.
Perfect. That's what I need to know. Thanks, guys.
Thanks for the call, Craig. I appreciate it. And this is a really nice ETF, by the way. It's a fund of funds. It is made up of the Avantis International Large Cap Value, the Small Cap Value, and the Emerging Markets Funds. It's those three funds, almost a third. Very, very close.
Must be having a banner year because International Small Cap Value is up like 38, Emerging Markets up like 30. So it's had a crazy year this year.
It's only had about a year, but so far, its 1 year return. Year-to-date return is 33%.
And what the money will flood in. People will wake up January 3rd and say, "Oh, I got to own that because it made 35%." You should have been
flooding into it a year ago.
I know. I just got off the phone with somebody else last week, and they thanked me for getting them into international last year. I said, "No, we've been saying the same thing for 25 years, so 30 years. So stop it."
Of course, we'd like to take credit for our brilliance, but we're not. We're just not that brilliant.
No.
Okay, we're coming up on the end of an hour. We want to thank you so much for being a part of this hour. For many of you, we've got another one coming up or another podcast tomorrow that will be from the same show. Call us 855-935-TALK. And if you have other questions, send them in at talkingrealmoney.com on the contact form. Either type them or speak them. And if you want to meet with one of our lovely Appella advisors, 100% fiduciary all the time. It's even in the paperwork. Just go to talkingrealmoney.com and click on the button that says Meet an Advisor.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.